Good afternoon, everyone. We're just at 4 o'clock. We're going to give people just a few minutes, a couple of minutes to get started. I know we had a number of attendees that had signed up for this, so we'll get started in just a few minutes. Thanks for your patience. All right, with that, I think we're going to get started to keep within our timeline. Good afternoon, everyone, and welcome. My name is Jeff Elastighi, founder and managing partner of the Legacy Group. Thank you for joining us for session 2 of our From Growth to Legacy webinar series, RSU Mastery, Turning Stock Compensation into Lasting Wealth. This next slide here is our compliance slide. It's kind of like your vegetables before desserts, not always thrilling, but absolutely necessary. Our compliance department needs to justify their existence, so they ask that we keep it there for more than 5 seconds. So basically says that, yes, we are giving you some advice, but we're not attorneys or accountants, and you should consult your, consult your professionals. But we do, as we always say, work with them collaboratively. So, but again, our compliance department absolutely insists that we tell you that. In any case, as I was saying, this 4-part series guides earners from income reliance to asset empowerment. In session 1, we covered financial independence foundations. Today, we're going to focus primarily on optimizing equity compensation, specifically RSUs. In session 3 and 4, we're going to be covering tax drag reduction and estate planning legacy. So we're going to keep these topics concise and make sure that we get as much information as we possibly can. So as you know, at the Legacy Group, our mission is very simple, is to help people and clients live a life of greater confidence, choice, and financial freedom. We do this through our service first philosophy and our 3-dimensional planning approach, integrating financial, legal, and tax perspectives. This afternoon, I am joined by my partners, Matt Wilco and Rob Sturgis. Together, our team specializes in estate planning, wealth management, and retirement and business planning, income protection for executive benefits and executives and high net worth individuals. Today, they will lead the content of today's presentation. Let me get through the agenda real quick. As I said before, today we're going to focus specifically on understanding RSUs, tax events, key career decisions, concentration risks, advanced coordinated strategies. And towards the end, we're going to have a live Q&A and also a preview of session 3. Throughout the presentation, we'll be monitoring the chat. So if there are any questions at any time, please just use the chat to ask. And we'll do our best to address them at that time if appropriate. Otherwise, we'll handle most of the questions towards the end. With that, I want to hand it over to Matt and Rob. Please, the floor is yours, gentlemen.
Thank you, Jeff. So what are RSUs? RSUs are restricted stock units. Pam, if you could go to the next slide. Restricted stock units are a form of compensation that employees typically at tech firms, healthcare firms, sometimes financial firms, are given as a way to compensate them or to entice them to join the firm for employment. The stock is given to the employee. However, it is not fully owned by that employee until they are hit certain vesting periods. Once that vesting period hits, whatever shares or whatever the value of those shares are at that point becomes taxable to the employee as ordinary income. As I mentioned earlier, a lot of companies in the tech world, biotech, healthcare, energy, financial, they use these to attract and retain the key employees that they feel are beneficial to the growth and expansion of their firm. When it comes time for you to earn these RSUs, they are typically set up on a vesting schedule. Most vesting schedules that we see are either predetermined on time such as a 4-year vesting period, where every year 25% is vested and become your asset. And in some cases, they're performance-based. And what this is essentially an incentive-based compensation strategy where the better you do, the more you earn, and the quicker you vest. Next slide, Pam. So what I'd like to do here is give you a real-world example of how RSUs are treated from a inception point to a receiving point and a tax point. So Jack here just received a job at a large publicly traded tech company. As part of the agreed upon compensation structure, part of his income or salary is going to be given in the form of RSUs. In this case, Jack was given a 4-year gradual vesting period. Essentially, every year from year 1 on, 25% of that vesting of that stock allocation will vest and become Jack's. After the shares vest, Jack is going to be faced with the opportunity to either hold on to the stock if he believes the company is going to continually grow and therefore provide more value holding on to it, or if he believes the potential is there to be volatile and he needs the equity, he can sell at that point. So let's assume the initial RSU strategy was 1,000 shares. Again, at $100 a share, he is going to be able to vest 250 shares each year for that 4-year vesting period. Now, under the situation, based upon the volatility in the market, you'll see here, if that $100 share price at granting date has grown by 10% to $110, those 250 shares would be worth $27,500 at the point in time that they vest in year 1. That's $27,500 of taxed earned income. Each year, what we did is to try to give you various points that, based upon the value of the share, dictates what your potential tax liability could be. So year 2, the stock doesn't perform as well, and those shares that were $110 last year are now worth $95, meaning that the taxable income to Jack is $23,750. The market changes over the next couple of years and the stock appreciates significantly. All this means is that if Jack does not sell any of these shares, while he has access and ownership of all 1,000 shares, he also has a tax liability of $138,000, almost $139,000 of earned income that essentially was given in the form of stock, not in the form of a paycheck. So again, understanding how these shares vest and understanding what your tax liability is key to understanding your compensation strategy and your compensation package. Next slide, Pam. So what are the pros and cons? And I'm going to be honest, I don't like using the word cons in here, or even drawbacks. I think what this gives you is just an opportunity to focus on planning strategies and how to avoid these becoming cons. But on the positive side, RSUs are a great way to recruit, retain, and incentivize employees to hit certain goals and help the company grow. In addition, it's another form of compensation. As those shares vest, it is assets of the employee that can help them, whether it be achieving more wealth, whether it be sold to generate cash flow. It gives the employee value and benefits. Again, if you happen to work for a company like NVIDIA, where all of a sudden the stock appreciates significantly, a lot of those employees have significant net worth based on the RSUs that they were received as part of their employment package. The other benefit is that it does not require the employee to purchase the shares. They are gifted to the employee as part of the employment agreement, thereby not having that original cost of buying the shares in the beginning. One of the things we will focus on later is that if you structure and plan properly, these RSUs can be something that can be set up for long-lasting wealth creation and legacy as you plan for your future and the future of your family. Now, as I mentioned earlier, we're going to call this drawbacks. I just think it's opportunities to make sure you plan properly. When the RSUs vest, they are taxed as income. They is not taxed as capital gains. Now, why does that matter? Because most people in these positions they tend to be high income earners and therefore are in a high income tax bracket. So capital gains tax rates are much more favorable than the income rates that are faced by these employees. Making sure that you're aware of this and you strategize properly is key to not just avoiding taxes, but just making sure you're mitigating them and you're being as efficient as possible. The other thing we discussed earlier is that, again, these are stocks. Stocks face volatility. The company's share price is predicated on the financial success of the company, as well as other extenuating circumstances or external forces acting upon the markets. Does the political climate drag down the market? Are there other things such as war or a global pandemic that will bring down share prices, thereby affecting your net worth and your assets? The other thing is, as we mentioned earlier, there are vesting periods. So if you're faced with that 4-year vesting period and you leave company in 2 years, what happens to those unvested shares? In almost all cases, those shares are lost. So something that was negotiated as part of a benefit package is no longer yours because you didn't satisfy that vesting period. One of the biggest drawbacks we see and one of the biggest areas that we focus on with our clients is that when these RSUs are granted, a large percentage of the employee's net worth is in one company. You are overexposed to the concentration of your portfolio being in one specific company. In addition, if you are not cognizant and you are not working with a tax professional that is familiar with how RSUs work, there are some complex tax reporting requirements that, if not handled properly, can cause you to be taxed more than once and not efficiently. Matt is actually going to go into a little more detail at a later part of this presentation, where he'll put some numbers to that to make you see. And for some of the people that are in this presentation or attending this presentation, might be coming in from California or New York, those states have different withholding requirements. And again, they potentially put you in a situation where you have to be cognizant of what the withholding requirements are, and if not set up properly, could all of a sudden be at a large liability in taxes if you don't handle it properly. At this point, I'm going to hand it over to Matt, who's going to focus a little bit more on the tax liability and landscape of RSUs.
Terrific. Thank you, Rob. And, that was a great start to the tax landscape of RSUs, which we're going to dive into in the next few slides, more specifics. And, one thing I would say right out of the gate when you're talking and examining RSUs is that they're complex financial vehicles, and they're equally as complex tax vehicles. So it is critical, and we'll touch on this more in the presentation, but it's critical that you have a qualified tax advisor who has experience dealing with RSUs, because there's a lot of different nuances that we'll get into now. So when looking at RSUs, there are two main taxable events. And with this being said, I will say the caveat that RSUs can be designed in a variety of different ways depending on the company and the structure that they decided to go with when setting up their RSUs. What we're going to talk about in the next few slides is what the lion's share of companies do. All right. But that being said, there might be some folks on the call today that their companies handle things slightly different. So the two main taxable events with RSUs are at vesting and at sale. At vesting, right, so when the shares vest and now they are available to you as the executive to potentially sell or not sell, that in and of itself is a taxable event. As soon as the shares vest, they count as income. And as Rob said before, for pretty much everyone on this call, income tax rates are more likely than not much higher than capital gains tax rates. So when they vest, they count as income, which are more likely than not going to get taxed much more punitively than when they sell, which is the second taxable event, in which case the delta between what the share price is when it vests and hopefully when it's much higher when you sell it, that delta is going to be considered your gain, and that portion is subject to capital gains tax rates. The portion below that is subject to income tax rates. So we go to the next slide. One common example, and we faced this actually recently with a new client that came to us that was working with a tax advisor that unfortunately, was not very familiar and didn't have a lot of experience with RSUs, and we're helping them navigate that situation now, is potentially double taxation. So what can happen sometimes is that the brokerage company that holds the RSU shares, right? Common companies are Fidelity and Charles Schwab and UBS, Morgan Stanley, big brokerage companies that your publicly traded company that's giving you these RSUs, they employ them to hold the shares. When they send you your tax document in the beginning of the year, typically in around February time period, believe it or not, they're not legally obligated to report the cost basis. This is called non-covered. Why this is important to you as an executive who gets RSUs is what I said before, there's two taxable events, right? When the RSUs vest, right, that is considered income. And then when you sell at a later date, whatever you sell it for, the delta between the vesting price and the sale price is what you have to pay capital gains taxes on. Well, if the brokerage company, when they send you your 1099, that indicates a zero cost basis, the entire amount will be treated as a capital gain, resulting in you potentially overpaying in taxes. So that's a little complicated, which is why in the next slide, we're going to go through an example that makes this a little bit more clear. So in this fictitious example, we have Jack, right? And Jack receives 250 RSUs from his company. And on the vesting date, the stock is trading at $200 a share. So doing some simple math, that's worth $50,000. So on that day that Jack receives those vested RSU shares, that $50,000 counts as W-2 income. So when he gets his W-2 at the end of the year, just like you've gotten since you had your very first job and got your very first paycheck, everybody gets a W-2 at the end of the year that they give to their accountant to help file their taxes. That $50,000 is on their W-2. It's not very complicated. It's straightforward. Federal, state, and local taxes are typically withheld. So in this situation, it's 45% for Jack because he's in a very high income tax bracket. Jack then 6 months later decides to sell these vested shares. And luckily for Jack, the share price has gone from 200 to 220, right? So he's made a $5,000 capital gain, right? Since he only held it for 6 months, that is considered a short-term capital gain, which will be taxed as income tax rates. If he held it for 12 months and 1 day or anything beyond that, it would be subject to long-term capital gains. So that's one pitfall that Jack might have not realized, that if he held it for a little bit longer, he might have been taxed at a lower rate. But to compound that, what happened, unfortunately, is the brokerage company, when they sent him his 1099-B, they did not report the cost basis. Jack did not realize that. His tax advisor did not realize that. So they're treating the entire $55,000 as a capital gain, and they want to tax him on that completely, which is not the way that it should be, because as you see in step 2, he's already paid, he's already withheld taxes on the lion's share of that. So that's where the double taxation trap can occur. Now, if we go to the next slide, we'll talk about ways to avoid this. All right. So this leads you with the question of, well, what do I do, right? I'm kind of, my expectation is that these professional firms that are sending me tax documents are reporting the correct numbers that I'm giving to my tax advisor, and they're following procedure. And I would say that, it's not an unreasonable expectation, but unfortunately, because of the complicated nature of RSUs, that's not how it always works, right? So it does fall on you to some degree to make sure that you're manually tracking your RSUs, meaning that when they vest, it's important that you take note of what your true cost basis is. Now, this doesn't necessarily mean that you have to write in a book, on today's date, I received X amount of shares and here was the cost basis. While you can do that, typically if you go onto your dashboard with whatever company is holding the shares, you can typically download an Excel spreadsheet or a schedule that shows you every vesting date and shows you what the cost basis is as per that vesting date. So a good practice is to hand your tax advisor not only the tax document the brokerage company sent you, but also that schedule, and ask them to make sure that they cross-reference the two to make sure that the true numbers are being reported. Of course, you could do that yourself as well. Right? It's always a good practice to review the 1099-B for errors, especially when you see anything that says non-covered shares. And lastly, as I started this section, it's really critical that you work with a tax advisor that has experience with RSUs and is aware of this double taxation trap and make sure that they're paying attention to this. So if we go to the next slide, Pam. So now let's talk about some overall tax traps to avoid when it comes to RSUs. So something that we see happen with a lot of folks is that they believe that RSUs are only taxed at sale. Remember the first slide in this section that said that there's two main taxable events, at vesting and at sale. A lot of people forget that as soon as the shares vest, that is a taxable event, and then they're shocked when a tax bill is owed or money is withheld, right? It's important to know that there are two different taxable events with RSUs. Going to the next trap, emotional selling. So another thing that we see happen to a lot of folks is they get overwhelmed by the complexity of RSUs and they kind of fall into this all or nothing world where I'm either going to sell all the RSUs the day that they vest, or I'm just going to not sell it at all and avoid dealing with it. Neither necessarily is the best strategy, right? Typically, when it comes to any kind of financial planning, all or nothing is usually not the best way, and usually taking a diversification approach and setting up a strategy to sell is usually what's best. Number 3 is the wash sale rule. So this is something unique that does happen. We've seen it before where if someone has their own personal brokerage account and they happen to be trading the stock that they're also getting RSUs for in their company brokerage account, they might sell in their personal account that share at a loss and at the same time receive a grant. And it can create a wash sale rule where it could disallow the loss, right? So it's complicated. A whole class could be, talked about when it comes to wash sale rules. The short version of that is if you're trading in your own personal account the same stock that you're also getting awarded, you need to be very careful with that, and you need to be very careful with being cognizant of when you're receiving vesting and when you're actively trading in your personal account that specific stock. And number 4, and I think this is really the most common that we see, is the under withholding surprise, right? Where clients get, they're shocked because they get a large tax bill when they file their taxes, and they say, how could this be? All my money is being taken out of my paycheck. I shouldn't have to owe anything. Well, depending on your tax bracket, right, and depending on what your company is automatically withholding for your RSUs when they vest, there could be a significant gap. So in this example, if they're only withholding 22% federally for taxes, but you're at a 37% tax bracket, right, that's a 15% delta. And depending on how much RSUs you're being awarded, sometimes hundreds of thousands, if not millions of dollars a year, that could result in a significant tax bill when you file. So it's important that you be intentional and you make sure that you check on things like how much is actually being withheld from my RSUs, and making sure that you're working with your advisors to make sure that that is the correct amount to avoid any surprises. And now I'll turn it over to Rob to handle this next section about concentration risk.
Sorry about that. Thank you, Matt. I think Matt did a great job talking about the tax implications of RSUs. And one of the bigger things that we see in addition to the tax treatment is the fact that the more people earn in RSUs, the more their net worth becomes tied to one specific company. Over-concentration risk, it happens when too much of your wealth is invested in one single asset, company, or sector. In regards to RSUs, we're talking about your employer. You're now relying on this company, 1, to generate the income that you're going to live off of, 2, provide you shares of their stock that you hope will grow, and essentially all of your net worth, or a lion's share of your net worth, is being tied up into one company. Now, again, as Matt talked about earlier with that emotional selling, where some people will either liquidate the entirety of the vesting just to get rid of it, or they'll hold on to it forever. Again, the more you hold on to it and the more you let it grow, when you look at your overall portfolio, you start to see that in regards to having a well-balanced portfolio, you do not have that. You have 50, 60, 70% of your net worth tied up in one asset, one company. The other thing is that people don't come up with the proper selling strategy. As Matt mentioned earlier, coming up with a strategy where maybe you sell 50% of it and you keep 50%, thereby allowing some liquidity and also being able to diversify your overall holdings. But what happens with most people is they kind of just let it sit in the background. They kind of just let the RSUs vest. They look at their statement, they look and see that their portfolio is growing, and they're happy because they see that, again, their net worth is growing. But the fact of the matter is that it's growing with one company, and anything that can happen to that company could have a significant effect negatively in your net worth. Next slide, Pam. So we use this example here with Tina, and on the slide we talk about what happens if 85% of her net worth is tied up in the shares and the company that she works with. And think back to COVID, March of 2020, the market dropped by 30%, over 30% in 1 month. If all of your equities or all of your net worth was in one company, and it wasn't a global pandemic that caused a shift in the market, but it was something specific to that company, well, in this case, Tina lost 40% of her net worth because she didn't plan properly and she didn't employ certain strategies that would mitigate the risk that she faced by such a large overexposure to one company. Most people don't realize how vulnerable they are to this until, unfortunately, it's too late. But in addition, there's one other, actually, if you can go back 1 second, Pam, there's one other key issue that some people don't realize. And let's say it's the exact opposite. The stock doesn't drop by 40%. What happens if the stock doubles? What happens if the stock triples? Look at, performance of Tesla, Nvidia, Microsoft, big companies over the years. They've significantly grown. And what happens when now you have a stock portfolio that is worth $8, $9, $10, $15 million? Well, now all of a sudden you have a potential estate tax problem. So making sure that you're always looking everything over and you're being efficient in how you plan and how you strategize is key, because the worst thing in the world is, amassing a large net worth and finding out that when you pass away, your biggest beneficiary is the government, not your loved ones. Go ahead, Pam. So, I think Matt hit the nail on the head on why people have a lot of overexposure or overconcentration, and it really all it's from emotion. People know the company well, they work for it, they feel like they're going there day to day, and they're contributing to the success and the growth of that company. And that familiarity, it sort of allows you the comfort level to not sell it because you feel a certain emotional attachment to it. Some people also feel like, if I work for this company, I have to believe in the company. So if I'm going to sell these stocks, it must be a disloyal, or it might be like a fear that all of a sudden I'm saying I don't believe in the future growth of this company, so they hold on to it. Again, as Matt mentioned earlier, sometimes people don't want to trigger those capital gains. So they say, you know what? I'm not going to sell because I don't want to have to pay unnecessary taxes. Again, sometimes paying taxes isn't unnecessary. Sometimes it's strategic. Sometimes having a comprehensive plan in place allows you to better diversify and set your family up better. And that may mean realizing gains and paying taxes on it. Again, another emotion. Everyone's afraid that the second they get rid of a stock, it's going to take off. And again, I understand that. But the fact is no one's telling you to sell all of those shares. You'll always hold on to something. You always have other shares that will be coming through the pipeline at future vesting dates. So not holding on to the fear that it's going to take off, but realizing you still have skin in the game if it does. But if it doesn't, you're better insulating yourself from unwarranted risk. The other thing too is that there are so many different things that you can invest in. What's the right thing to invest in? And sometimes you kind of get that paralysis by analysis and not knowing what the right venture is, not knowing what the right investment is. People sort of say, I'm not going to do anything because it's just too confusing. Again, inaction is not the right action. Pam, next slide. One of the things, you know what? I apologize. One thing I wanted to discuss and I didn't bring up, there's another thing that people don't focus on. And that's, RSUs are given. But one of the other benefits you have when you work for a company that has publicly traded shares, a lot of times those shares are available to be purchased either on an employee purchasing plan where you can get it at a discount, or a lot of times people can purchase the shares in their 401k. And a lot of times what that winds up doing is that almost further compounds the issue, because all your investment vehicles that you're utilizing to buy shares in the same company. We had a case we were working on with a client of ours that, had worked for Microsoft for years, achieved very good levels of wealth, but, worth about $12 million, $9 million of it was in Microsoft stock, and he did not want to sell it. So again, it becomes tough that all of a sudden now 75% of the client's net worth is in one company. And that was spread across his RSU account. It was spread across his employee stock purchase plan, and it was in his 401k as well. So these are things to consider. I don't know how old everyone on this call is, but the old Enron days where, they said you should never have more than 10% of your investments in your company's stock. When you work with these companies that are giving RSUs, a lion's share of their net worth, 40, 50, 60%, is in one stock. Again, it's imperative that you plan, that you review options, and you understand that what you're doing is intentional and not by accident. At this point, Matt, I'm going to hand it over to you to take us home.
All right, great. Thank you, Rob. So going to the next slide, Pam, there's 4 key actions to successfully navigate RSUs. And before we get into each one of these 4 topics, the resounding message with what we're about to go to is really intentionality, right? RSUs are complex financial and tax vehicles. And what we've seen happen to a lot of executives in the past is that they don't fully appreciate how complex it is, and they're not intentional themselves, or they're not intentional with the advisors that they're working with to make sure that they're taking the necessary actions to avoid some of these drawbacks that don't necessarily need to be drawbacks, to Rob's points before. So, the biggest message that I would love to impart on the crowd today is really that if you're getting RSUs, especially if you're new to the world of RSUs, you have to be intentional. You have to pay attention to this. And at the very minimum, if that's not something that you really are too keen on doing, you need to be intentional about getting really good advisors in place to make sure they're looking at it for you on your behalf. So that being said, let's look at each one of these. So the first is that we want to set up proper tax withholding before each vest. So we touched on this before, right? That it's very common that companies automatically put you into a 22% federal tax withholding for your RSUs. And if you're a highly compensated employee or executive, more likely than not, you're in a higher tax bracket than 22%. What does all this mean? It means when you file your taxes, you're going to get hit with a big bill, right? All of that could be avoided by just being intentional about looking at, well, what are they withholding? What should I be withholding based on my bracket? And let me make sure there isn't too big of a gap there. Okay, so it's a very simple fix to avoid a really large surprise bill that you might not be expecting. Number 2, create a systematic diversification plan. All right, to Rob's point before about concentration risk, it is very common, especially if you're working at a very successful company that has seen a very dramatic rise in the stock price, that you're going to have a concentration risk issue where a lot of your net worth is tied to that one particular stock, right? Now, at the end of the day, that's a good problem. I'd much rather have millions tied up in one particular stock than not have it at all, but it still is an issue, and making sure that you're intentional about creating a plan to make sure your assets are diversified, because while it's great that you've built so much wealth in that stock, you want to protect the wealth as you're building it. And what we don't want to see happen is to see the stock price fall and that potentially cause a lot of loss on your behalf. And it doesn't necessarily mean that you have to sell the stock, right? There are other strategies that we help clients implement if they don't want to sell. So for example, we help clients put in place what are called options collars, which, to not get too deep into the strategy because it's very complex, but you buy what are called put options against that stock, almost as like insurance, to say that if the stock price does drop, the value of those put options is significant, and that hopefully offsets a lot of the loss. So a lot of times if folks are not in a position where they want or can sell their RSUs, putting in place some put options against them could be a good hedge to make sure that they're protecting themselves against loss. That, and of course, with divesting themselves of the shares. Third, coordinate RSU decisions with overall goals. So very frequently we help clients that say, I need to look at my vesting schedule. I need to determine how much I should sell, when I should sell it, and I want to coordinate that with me buying a second home, or me upgrading my primary home, or me going on a large renovation budget on my home, whatever the case may be, or, paying tuition expenses for my children, right? There's a whole slew of different milestones in life that are going to require significant financial commitments and backing, and coordinating that with your RSUs is a good thing. Number 4, and we've talked about this a few times already in this call, is work with advisors who understand equity compensation. It's critical that you have a good tax advisor who has experience with RSUs. It's equally as critical, I would argue, that you have good financial planners and advisors in place that understand that as well, to make sure that all of these different aspects and complexities of RSUs for your specific situation are being addressed. Pam, could you go to the next slide, please? So last slide in this segment, and then I'll hand it over to Jeff to finish us off this afternoon, is navigating RSUs successfully. Equity compensation should never be an afterthought when changing jobs, retiring, or negotiating offers. All right. So for example, the first thing that you see here, when walking away from unvested RSUs, I've been in a situation frequently with clients where they have hundreds of thousands, sometimes millions of dollars in unvested RSUs, and they want to leave the company. Whether that could mean that they have a better offer somewhere else, or what they think may be a better offer, or they're just not happy and they just can't continue to work there, right? A lot of times it's a personal decision, right? Whenever you're, considering about, do I want the money or do I want happiness, right? That's a personal decision that as advisors, we can't make for clients, but what we can do is make sure that clients know the cost of the decision, right? The last thing that we want is somebody to make a decision thinking that they're losing X, but they're actually going to be losing Y, right? That's not a fun position to be in. So we want to make sure that we're equipping clients with the research to make sure that they're fully aware of what they're potentially walking away from before making their decision. And then that can lead into the next topic, which is negotiating a signing bonus, right? So when negotiating with the company that you may be moving to, it's important to note, well, I'm going to be walking away from this amount of equity compensation, right? So this new company hopefully can make me whole, if not in a better position, right? So understanding what you're walking away from is going to put you in a position of strength when negotiating with the next company. Retirement timing, right? This is a common one as well, right? I want to retire. I want to be done, but I have, over the next few years, several tranches of RSUs that are going to be vesting that are worth significant amounts. Do I forfeit that, or do I stay on for another few years? Again, like with item number 1, a lot of that is a personal decision. Is it worth the extra compensation to stay, right? That depends on how much you like your job and how much you want to retire, right? But it's our job as advisors to make sure that clients are fully aware of, if they do decide to retire and walk away from that compensation, that there are no surprises and they know exactly how much they're going to be walking away from. So if they do make the decision to walk away, they know exactly what they're losing, and they're not finding out after the fact that they're actually losing a whole lot more than they thought. At the top on the right, sabbaticals, parental leave, and career breaks, right? Before making a decision to go on leave, right, that can have an impact on your vesting schedule and your RSUs that you're going to be awarded, right? So sometimes we don't have choice whether or not we go on leave. Or sometimes it doesn't, the money doesn't matter, right? We need to go on leave for personal reasons, right? But just like the things that we talked about before, it's important before making those decisions of going on leave or not, that you fully understand what you're potentially forfeiting. And that's our job as advisors, to make sure clients are aware of that so they can make well-informed decisions. Tax implications of career transitions. So very often we'll see executives transition to a different career or different company, halfway through the year, right? This can have an impact on what tax bracket they're in. And they may think that this also has an impact on the amount of taxes that they're going to lose to their vested RSU shares. And that sometimes is the way it works. Sometimes it's not, right? So again, when making a big decision, like transitioning to a different company, making sure that you're working with good advisors that are analyzing all these things for you so that before you make your decision, you're fully aware of the impact is a good idea. And lastly, strategic timing around life events. And I talked about this in the last slide, where it's very common where folks will want to time the sale of their RSUs or analyzing their vesting schedule and marrying that up with different life events that are going to have large financial impacts, and working with an advisor that's familiar and can make sure that, double checking your work, so to speak, and bringing to light different strategies that you may or may not be aware of. All right, with that being said, the last segment here is about advanced coordination strategies, and I'll hand it over to Jeff for this final component.
Yes, thank you, Matt and Rob. As we wrap up the formal part of the content, you both have raised some really good content and points. And I think the message, there's a couple of messages. I know Matt said a few messages, but the one I love for people to walk away with is that financial planning is a conversation. All we're talking about here is we threw a lot of different scenarios as to how potentially RSUs can be an impact, right? And it could be a good thing and it could be a bad thing. Obviously, I hope what we have conveyed today is that, in the absence of planning or an intentional plan, it could be detrimental from a tax perspective. So, we're here to help you make complex decisions clearer, right? Whether they're technical or just a personal what if scenario, we're here to help, right? And a lot of times, a lot of answers come out of just simply talking out loud with people like us. In those scenarios, right? We often work a lot with clients because they get stuck in overthinking the many scenarios that may or may not be applicable. So we can help through that process. So to wrap up, turning equity compensation into a strategic advantage is really something that we're going to really focus on the next session, right? But RSUs become significantly more powerful when they're coordinated with your broader financial plan or even an estate plan. Aligning your sales, the taxes, and the diversification with long-term goals can transform an RSU from an unpredictable income into a meaningful wealth building strategy. So, there are a number of advanced things that we'll highlight today in the screen, right? And, one of them being tax loss harvesting. Making sure that, if you don't have to sell them, don't sell them, right? And if you have losses in other parts of your portfolio, it could be a good way to trade off that gain with losses in other investments that you might have. Reducing concentration risk through disciplined selling strategy. I think Matt did a good job going through that part. Using gains to support long-term planning goals such as retirement, savings, and charitable giving. Charitable planning is one of those things where it's usually the last thing that people think about, but there are a lot of benefits that create a win-win-win, right? A win for you, a win for a charity, and a win for your family. The only one that really gets cut out here is Uncle Sam. I'm not saying that you shouldn't pay taxes, but there are a lot of options available to you, which we'll get into more in detail in the next two sessions. So the goal isn't perfect timing. It's really creating a system that reduces risk, improves tax results, and aligns equity with your overall plan. At this point, I want to really open it up for Q&A. I know there were a couple of questions that I saw pop in. So looking ahead while we pull out these questions. This is a key lever in accelerating long-term wealth creation. How do you go from, hey, we're making a lot of money, we're accumulating assets, but how do you really turn wealth into a legacy? What does that actually mean, right? And Believe it or not, your biggest problem, or a lot of times what we see from clients, it's taxes. And again, taxes is one of my favorite topics because whether it's income tax, capital gains tax, or an estate tax, it seems like you're always getting hit by that three-letter monster, right? And we're here to help with that. So with that, we do have some questions. Let me see. I think the first one that came in, how much of my net worth is too much to have in RSUs? Matt, Rob, any one of you want to take that question?
Yeah, I can jump in. Uh, Again, I don't think that this is a one size fits all. I think a lot of things are going to be dependent upon your stage in life, what your company you work for is. Is it a more stable company? You know, companies that are less volatile, let's say Microsoft compared to Tesla. Again, both very good companies, but the volatility of the company would kind of shift the decision. So there's multiple factors that go into it. Again, I would say that, you know, also, like I said, mentioned the stage that you're in life. You know, if you're young and just starting out, you know, it may be the only thing you have. So having a larger percentage of your net worth in one company may not be as detrimental as if you're in the later stages of years of getting closer to retirement and getting closer to needing this asset have to become income producing. So I think there's a multiple of variables that go into that. And it's not just here's your firm answer across the board. I think everyone needs to look at their own specific situation.
And that's a great, and let me piggyback on that answer a little bit, Rob, because as you're talking, two scenarios, two very different scenarios kind of pop into mind, right? Where we've worked with young executives, and what I mean by young, late 30s, mid 40s, right? Making 500,000, 600,000, and they have a few million in RSUs, right? That is a much different picture, right? So let's say if that person has 70 or 80% of their net worth, in one stock, right? It's much different than if a second scenario, right? Another very real client they were working with, where the guy's at the tail end of his career and has 95% of his net worth tied to one stock. And that's scary, right? And so there's no perfect answer. I would tell you in the second scenario, that is too much, right? So, but who am I, right, to tell them, hey, get rid of the one stock that has created essentially all of your wealth. But so there's no right or wrong. I think it goes back to what Rob said. I was having a conversation and really prioritizing, creating a list of priorities. What's important? What is what are your intended goals, and what is your intent with that money, right? So moving on, there's another question. How much should I withhold from taxes? Matt, you want to take a stab at that one?
Sure. So, this is really, the first person you should always ask this question is to your tax advisor, right? Because they're going to be the ultimate authority on taxes, and they're going to, they're the one that's filing your tax return for you each year. So nobody is going to be more intimately familiar with your specific tax situation than your tax advisor, usually a CPA. So I would first direct this question towards them. But if you want a little bit more education, as opposed to just, saying go to your tax advisor, the very simple answer is, to go online and start reading about income tax brackets, right? And familiarizing yourself a little bit with, what bracket am I in? All right. And there's different layers of taxes, right? There's federal taxes, depending on what state you live in. There's state taxes. Sometimes there's even local taxes. Like, so for example, in the New York metropolitan area where we're based out of, if you live in New York City, you're paying federal taxes, you're paying New York state taxes, and you're paying New York City income taxes, right? Then there's other layers such as Social Security taxes, Medicare taxes. So it gets very complicated, but some of the best education is to just YouTube and watch a 2-minute video on how taxes work, and getting a little bit of familiarity behind that is going to go a long way in you understanding things like how much should I withhold. So when you do go to your tax advisor and they start talking to you about these types of conversations, you're not completely lost, because I've seen it happen with clients in the past where if they're almost illiterate when it comes to taxes. Even when they're getting good advice from a tax advisor, they don't sometimes even just know enough on how to handle that advice. I would challenge everyone in the crowd to say that, if you're getting RSUs, you've achieved a level of success in your career, that taking a little bit of the next step in making sure that you understand just the very basics on taxes and how withholdings work is usually a good idea. Now, with that being said, to answer the question, it really depends on what income tax bracket you're in. So it may be, 30% may be sufficient for one person and 50% may be better for someone else. So it really depends on how much income you're earning, where you live, and at the end of the day, getting advice from your tax advisor.
And Matt, if I could add to that, assuming that, your current year is going to be somewhat similar to your prior year, there's always the possibility you can review your previous year's tax return and look for your affected tax rate. If everything's the same and there's not going to be much variable, look at what you paid overall last year, and it can avoid two things. One, potentially not withholding enough and getting a bill, but in addition, not withholding too much and giving the government an interest-free loan.
Good. Yeah, good thought, Rob. Last one. Is there an optimal time of the year to sell RSUs for tax purposes? So I guess I'll kick it off because I think I talked about that in the previous slide. But that's tax loss harvesting, right? Look, is there an optimal time? Look, if you need to sell in January because you haven't something you need, you have to do it, right? But if I'm thinking strategically, right, tax loss harvesting is when you have losses in other parts of your portfolio that can help offset any gains, right? So we're hoping that when you are selling your RSUs, that you're doing it at a gain. That doesn't always happen that way. But if that is the case, before the end of the year, so that you're selling your RSUs and you're selling anything at a loss, in the same tax year. So I think that would be one answer to that. I don't know if there's anything else you guys can think of, adding to that.
No, I think, like you said, as part of a comprehensive plan, the strategy you mentioned, or Matt mentioned, where a lot of times people have these vesting schedules earmarked towards home purchase, second home purchases, college. So if part of your strategy is to sell every year in January, and January happens to be a really strong part of the year, and you have a significant gain that was just realized, to Jeff's point, being cognizant of that and knowing that if the stock doesn't perform as well for the remainder of the year, selling some of those shares at a loss to offset those gains is key to mitigating tax liability.
Yes.
Yeah. And the only thing I would add is that it's not, to answer the question, it's not like in January taxes are treated any different than they are in July, right? It's always looked at as in a calendar year. But, to piggyback off what both Rob and Jeff are saying, where it can matter is it depends on what else is happening, right? What other capital gains, what other income, what other capital losses do you have happening in that particular tax year? And that needs to be coordinated with when you're selling. Another common thing that we see is, if you're going to sell on December 30th, it might be more advantageous for you to sell on January 1st, just 2 days later, because you've crossed into a different tax year, and that potentially could have a meaningful impact on how much income you have. It doesn't, how much taxes you have. Inherently, there's no difference between December 30th and January 1st. It really depends on what else is happening in your financial and tax life.
All right. With that, are there any more questions? Guys, I really, again, appreciate the time you guys took out of your day to be with us for these 45 minutes. I hope you found the information helpful. And, we look forward to continuing this journey of education with you around RSUs and what we can do to help, your planning in the future. Thank you again. We're around for questions, additional questions. Send us an email, make a phone call, or there's links on our profiles for any meetings that anybody's interested in. Once again, thank you and have a good afternoon.
Thank you, everyone.